Aloha, I'm Carl Bonham, the Executive Director at UHERO and a professor in the Department of Economics at the University of Hawaii at Manoa. I'm here with another UHERO focus, and today we're going to be talking about our latest forecast report. And as you can see from the title, we're forecasting a U.S. recession. That's in our baseline forecast. The story is also that Hawaii doesn't necessarily have to enter a recession. It's not true that whatever happens on the continent happens in Hawaii, 6 months later. That's just not the way it works. We think there's a good chance that Hawaii won't go into recession, mostly because of where we are in our recovery and the continued recovery of international visitors. The real story for the last year and going into all of 2023 is going to be inflation. The slide that I'm showing you shows 2022 inflation in the blue bars through July. And on the far right, you can see total inflation was over 8%. And the problem is even as the transitory components like energy and food prices and used and new car prices, even if those components of inflation come down strongly, the core or the non-transitory inflation can still remain elevated at 4.5%, 5%. And a lot of that is because of the surge in household costs, in rents, in shelter for the last year. Really all the way through the end of 2021, rents nationally were rising very, very strongly in high double-digit rates. Those growth rates have come down some, but they're just now starting to show up in the consumer price index that the Federal Reserve is watching. And so actually in August, the shelter component of the US CPI grew at over 6%. And that's the first time we've seen those kinds of numbers. And that's going to continue well into the end of this year and the beginning of next year, leading the Fed to continue raising rates, right? We saw a 75 basis point increase in the Fed funds rate this week. We're likely to see another 75 to 100 basis points before the end of this year. And we're in a new rate environment where interest rates stay higher for longer than most people expected, certainly higher and longer than the bond market expected. And that's having the effects that the Fed would like it to have, which is to slow demand, particularly in housing. And so this slide that shows our mortgage rate forecast sort of gives you the idea of interest rates going up higher into 2023 and staying elevated all the way through the end of our forecast sample to 2027. And those high mortgage rates have really brought house buying, new home sales nationally down to close to recessionary levels. So new home sales are a leading indicator of recessions. So are yield curve inversions, and we're watching those. And all of those are signaling to us that we should see a recession sometime in the next 12 months. Our forecast is for a modest recession nationally, with U.S. real GDP growing for all of 2023 at less than 0.5%. With the recession happening in the first half of the year. We'll probably be wrong about when it happens, but we still think it will occur in 2023. And the primary reason that we think that Hawaii may escape this recession is we're out of sync. Right? We have not recovered our job counts are still 7% below pre-pandemic levels. Nationally, their jobs have completely recovered. Labor markets on the U.S. mainland are extremely tight, tighter than they are in Hawaii. We haven't seen the kind of wage growth. We haven't seen the kind of inflation that we've seen nationally. We've seen much lower inflation rates, still high, but much lower. And if you look at this slide that shows the various components of visitor arrivals, you'll notice that the U.S. visitor arrivals, which is the blue line, these are all indexed to January of 2020. Look at the U.S. line in 2021 and 2022, and it's up at 110, 115. That's a 10% or a 15% higher than it was before the pandemic. In contrast, the rest of the market is still trying to catch up. Canadian arrivals surged in the second half of 2022, didn't have a breakout winter because of Omicron, but we expect that this winter, particularly if it's nice and cold in Canada, we could see new record highs for Canadian visitors. It's the Japanese market that we've really been waiting to see recovery, and that was hit again with actually the worst wave of COVID that Japan has seen happen this summer, but their travel restrictions have begun to ease. We're up to 20% of pre-pandemic levels. We think we'll get to 50% by early part of next year. And that improvement in the international visitor market will offset what we expect to be a decline in the U.S. market associated with that U.S. recession. And so those together, along with other factors such as federal spending on construction, we've seen a large increase in federal dollars flowing into Pearl Harbor and into the Infrastructure and Jobs Act, leading into money that goes into state coffers for spending on construction. Those will help to offset a recession in Hawaii. And so if you look at our chart here of the unemployment rates, this compares our previous forecast, our second quarter forecast, with our current third quarter forecast. And what we're seeing is just a slight increase in the unemployment rate. We've seen a big increase in labor force. It's actually led to a slight uptick in unemployment, but labor markets are going to loosen up just a little bit. It'll be a little bit harder to find a job, but we're not talking about a really deep slowdown. And so in longer term, we're really looking at Hawaii sort of returning to a more normal growth pattern, something on the order of 1% job growth, 1.5% real income, and something like 1% real GDP growth. So that all in all, this is a somewhat disappointing, right? We'd like to have that soft landing that the Fed was hoping for. We just don't think that's going to happen. But at the same time, we think this will be something that we'll get through in Hawaii without a deep downturn. Mahalo.